Okay, good morning again. So this is our second part of our lecture video regarding our topic business combination and consolidated financial statements. So before we start with the consolidated FS on the date of acquisition, let me emphasize some points regarding our previous video, the merger or acquisition of net assets. Number one, again, acquisition related costs like accountant's fee, finder's fee, legal fees, also the indirect costs like salary of accountants, salary of lawyers, they are debited to expenses. They are debited in the books of the acquirer or the surviving company, debiting an account title expense, not retained earnings. Only for the sake of the question, how much is the retained earnings immediately after the merger? Again, considering that the only FS available on the date of acquisition is the statement of financial position. So all those items affecting expenses and income. So again, those items that were debited in the books of the acquirer to expenses and that was credited in the books of the acquirer to income, we, for the sake of the question, RE on the date of acquisition, we affect them. They are one of the items which will affect RE by increasing RE, gain on acquisition, or decreasing RE because they are expenses incurred. But they are not debited or credited to RE. Just to make it clear. Okay. Number two is the contingent consideration. Again, contingent consideration is part of the total consideration on the date of acquisition, and it affects the computation of goodwill or gain on the date of acquisition. The contingent consideration is usually based on a targeted profit, targeted sales, targeted income. It is sort of a promise coming from the surviving company to the stockholders of the acquired company, which will be transferred on after reaching a specified or a targeted goal. And it is being recognized as a liability in case the contingent consideration, the item to be transferred in the future, is a financial liability if in case it is we are to transfer cash in a future date. So on the date of acquisition, we measure that consideration to be transferred again only to the extent it is probable and measurable, which may change if the estimate based on improved information from facts and circumstances already known on the date of acquisition, and it is within 1 year or 12 months, again, goodwill or gain will be affected. Otherwise, if it is beyond 12 months, even if it is based on an improved information from facts and circumstances known on the date of acquisition, but again, beyond 12 months, it will not affect goodwill or gain anymore, but instead income. Also, if it's within 1 year or within 12 months, but it is not based on facts and circumstances already known on the date of acquisition, it will also affect income. And third reminder again, bond issue costs, stock issuance costs, acquisition-related costs will not affect the computation of goodwill or gain on the date of acquisition. It will affect, again, expenses if it is acquisition-related costs, equity if stock issuance costs, and the liability account if in case it is bond issue costs. So then we proceed with the acquisition of stocks or the relationship of a parent and a subsidiary or group of companies. So number one, in computing, of course, let me remind you that the lecture video is not to duplicate the solution I already provided and uploaded. It is already a comprehensive solution, a written comprehensive solution I prepared. So I guess the lecture video is to give you some reminders, the concept, concepts, no, in relation to our topic. So I hope at this point you are just somehow refreshing what you already know. Hopefully nakalimutan lang. So again, these are all reminders. So number 1, in computing for the goodwill or gain on the date of acquisition for an acquisition of stocks, we consider the aggregate. On the part of the acquirer, we consider the aggregate of number 1, the price paid, the consideration transferred, which again may be in form of cash, shares, make sure at fair value, bonds at quoted price, or non-cash. Then if in case the acquired company is not a wholly owned acquired company, it is not a wholly owned subsidiary, then there is a need to recognize the amount of the non-controlling interest, which may either be at fair value or at the proportionate or relevant or minimum share. It is actually based on company policy. But if in case worst comes to worst, problem is silent, then NCI is measured or recognized at fair value because we are adhering towards total consolidation. And I hope at this point we know that if the non-controlling interest will be recognized at fair value, and after checking that fair value is not lower than the proportionate or minimum or relevant share, which is the 20%, the 10%, or the 30%, or the 40% of the identifiable net assets at fair value of the acquired company, then of course we use the fair value. Number 1, because again it was mentioned in the problem that the NCI is recognized at fair value or the problem is silent. Then we check if that fair value is not lower with the minimum, with the guaranteed, with the proportionate, with the relevant share. Then we use the fair value. Then the resulting goodwill will be a total or a full goodwill. A goodwill which is attributable to parent and to controlling and to non-controlling interests. The third item in the aggregate amount is if in case of step acquisition or acquisition through stages, the fair value of the previously held securities. So if in case previously we acquired 30% or 40%, obviously there is no control. In the absence of prima facie evidence, there's only a significant influence, let's say. Then subsequently we acquired another shares. Then after which there's already a control. Then we measure the fair value of the previously held securities. So again, the 3 items forming the aggregate are number 1, the price paid for the current or the new acquisition of shares. Number 2, the NCI. We recognize the non-controlling interest either at fair value or if in case the proportionate share if the subsidiary is not wholly owned. And third, the fair value of the previously held securities in case of acquisition through stages. So while waiting, we go to the other side. We need the net assets, again the identifiable net assets at fair value. Or if not, since this is acquisition of stocks, we may start with the stockholders' equity of the acquired company. So it is also the net assets at book value. So just take note that we exclude any previous goodwill of the acquired company. In case of the goodwill of the acquirer or the parent, hands off. We are hands off. No? Hands off tayo dun. Our only concern is that we exclude the previous goodwill of the acquired company. So if we will start with the stockholders' equity of the acquired company or the net assets at book value, we need to find out if the assets and the liabilities of the acquired company on the date of acquisition has an equal book value with the fair value. Otherwise, if not, then there will be an identifiable excess, which can either be under valued if the fair value is more than the book value, or overvalued if in case book value is more than the fair value. Take note that on this lecture video, I'll be discussing acquisition of stocks on the date of acquisition, so as not to mix up with the subsequent acquisition. So we only focus with the excess, the amortization of that excess to follow. So again, if the aggregate amount is more than the identifiable net assets at fair value on the other side, then the result is a goodwill. And that goodwill is full or total, meaning attributable to controlling and non-controlling if the NCI was recognized at fair value. Otherwise, if the NCI was recognized at the proportionate share, why? Because number one, the problem stated that the NCI must be recognized as a company policy at the proportionate or minimum or guaranteed share. Or number two, if initially the NCI is to be measured at fair value, but after checking the fair value is lower than the proportionate share, then we ultimately use the proportionate share. If the fair value upon checking is lower than the proportionate share. Again, it is not whichever is higher, but it is more of that the fair value is more. And the fair value is not in any way will be lower than the guaranteed or the relevant or the proportionate share. If the company again will state that the NCI is measured at fair value, then even if we find out that the fair value is higher than the proportionate share, still we'll be using the proportionate share. So again, it is not whichever is higher, it is just that the fair value, if in case, must not be lower than the proportionate share. I hope that is very clear. Okay, so, control premium. Control premium is part of the price paid, and it will definitely be part of the price paid. In the books of the acquirer, once the acquirer will debit investment in the subsidiary, investment in S company and credit, example cash, that amount will include already the control premium. But control premium is something attributable only to the acquirer, and in no way that control premium will be allocated to NCI. So if in case there will be a need to find out how much is the assumed fair value of the NCI, assuming there is no fair value given, and we will be using as a valuation technique the price paid, which may include already the control premium. So we remove first, we remove the control premium temporarily. We remove the control premium from the price paid just for us to be able to assume the fair value of the NCI. For example, if 1 million is the price paid, including a control premium of 20,000 for an 80% ownership, so in order for us to compute for the assumed fair value of the NCI, there is a need first to deduct the 20,000 control premium from the price paid before i-divide siya sa 80%. So 1 million less 20,000 over 0.80 times 20%, then that will be our assumed fair value of the NCI. Of course, we need to check if that fair value is not lower than the proportionate share. Otherwise, it will be lower. We will use the proportionate share. Then, of course, after we found out the NCI at fair value and it is not lower, again, the price paid will still include the control premium. We only remove the control premium only to compute for the assumed fair value of the NCI. Control premium, again, is part of the price paid but only attributable to parent. In no way, NCI will be allocated with the control premium. So, it is only goodwill, which can be a total goodwill resulting from recognizing NCI at fair value, or a partial goodwill, a goodwill which is attributable only to parent if the NCI is measured at the proportionate share. So take note, if the non-controlling interest is measured at the proportionate share or relevant share, the resulting goodwill is a partial goodwill attributable only to parent. gain on acquisition will always be and will only be attributable to parent. There is no such thing as gain on acquisition affecting NCI. So, that will be all for this lecture video. To be continued.